Hi guys, Michael here. Today I will discuss chart patterns that every trader needs to know. So, chart patterns are an integral aspect of technical analysis, but they require some getting used to before they can be used effectively. To help you get along with them, here are 10 chart patterns every trader needs to know. So a chart pattern is a shape within a price chart that helps to determine what price might do next, based on what they have done in the past. So chart patterns are the basis of technical analysis and require a trader to know exactly what they are looking at and as well as what they are looking for. And there is no one best chart pattern because they are all used to highlight the different trends in a huge variety of markets. Often chart patterns are used in candlestick trading, which makes it slightly easier to see the previous opens and the closes of the market. Some patterns are more suited to a volatile market, while others not so much. Some patterns are best used in a bullish market and others are best used when a market is bearish. So that being said, it is important to know the most effective chart pattern for your particular market, since using the wrong one or not knowing which one to use may cause you to miss out on an opportunity to profit. And we all hate that feeling, right? Yeah, well, before getting into the details of different chart patterns, it is important that we briefly explain support and resistance levels. So, support refers to the level at which an asset's price stops falling and bounces back up. A resistance is where the price usually stops rising and dips back down. The reason levels of support and resistance appears is because of the balance between buyers and sellers, or other words, demand and supply. When there are more buyers than sellers in a market, or more demand or supply, the price tends to rise. When there are more sellers than buyers, which is more supply than demand, the price usually falls. As an example, an asset's price might be rising because demand is outstripping supply. However, the price will eventually reach the maximum that buyers are willing to pay, and demand will decrease at that price level. So, at this point, buyers might decide to close their positions. This creates resistance, and the price starts to fall towards a level of support as the supply begins to outstrip demand as more and more buyers close their positions. Once an asset's price falls enough, buyers might buy back into the market because the price is now more acceptable, creating a level of support where supply and demand begin to equalize. If the increased buying continues, it will drive the price back up towards a level of resistance as demand begins to increase relative to supply. Once a price breaks through a level of resistance, it may become a level of support. So, let's talk about the types of chart patterns. They fall broadly into three categories: the continuation patterns, reversal patterns, and bilateral patterns. So, a continuation signals that an ongoing trend will continue. Reversal chart pattern indicate that a trend may be about to change direction. And bilateral chart pattern lets traders know that the price could move either way, meaning the market is highly volatile. You can take advantage of those moves by opening trades with CFDs. This is because CFDs enable you to go short and long whichever way the market is moving, meaning you can speculate on markets falling as well as rising. So you may wish to go short during a bearish reversal or continuation, or long during a bullish reversal or a bullish continuation. So whether you do so depends on the pattern and the market analysis that you have carried out. The most important thing to remember when using chart patterns as part of your technical analysis is that they are not a guarantee that a market will move in that predicted direction. They are merely an indication of what might happen to an asset's price. So let's start from the number one, which are pennants or flags. Pennant patterns or flags are created after an asset experiences a period of upward movement, followed by a consolidation. Generally, there will be a significant increase during the early stages of the trend before it enters into a series of smaller upward and downward movements. Pennants can be either bullish or bearish, and they can represent a continuation or a reversal. So pennants can be either bullish or bearish, and they can represent a continuation or a reversal. So in this respect, pennants can be a form of bilateral pattern because they show either continuation or reversals. So while a pennant may seem similar to a wedge pattern or a triangle pattern, so it is important to note that wedges are narrower than pennants or triangles. Also, wedges differ from pennants because a wedge is always ascending or descending, while a pennant is always horizontal. So, second is the round bottom. A rounding bottom chart pattern can signify a continuation or a reversal as well. For instance, during an uptrend, an asset price may fall back slightly before rising once more. An example of a bullish or reversal rounding bottom would be if an asset's price was in a downward trend and a rounding bottom formed before the trend reversed and entered a bullish uptrend. So, traders will seek to capitalize on this pattern by buying halfway around the bottom at the lowest point and capitalizing on the continuation once it breaks above a level of resistance. So, 3 is cup and handle. The cup and handle pattern is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. So the cup appears similar to a rounding bottom chart pattern, and the handle is similar to a wedge pattern, which I will explain in a second. So following the rounding bottom, the price of an asset will likely enter a temporary retracement, which is known as the handle because this retracement is confirmed by 2 parallel lines on the price graph. The asset will eventually reverse out of the handle and continue with the overall trend. So, fourth is the most famous head and shoulders. Head and shoulders is a chart pattern with a large peak that has a slightly smaller peaks on either side of it. So traders look at head and shoulders patterns to predict a bullish to bearish reversal. Typically, the first and third peak will be smaller than the second, but they will fall back to the same level of support, otherwise known as the neckline. Once the third peak has fallen back to the level of support, it is likely that it will break out into a bearish downtrend. Now the double top. A double top is another pattern that the traders use to highlight trend reversals. Typically, an asset's price will experience a peak before retracing back to a level of support. It will then climb up before once more reversing back more permanently against the prevailing trend. So next one is double bottom. A double bottom chart pattern indicates a period of selling, causing an asset's price to drop below a level of support. It will then rise to a level of resistance before dropping again. Finally, the trend will reverse and begin an upward motion as the market becomes more bullish. A double bottom is a bullish reversal pattern because it signifies the end of a downtrend and a shift towards an uptrend. Next, we have ascending triangles. The ascending triangle is a bullish continuation pattern which signifies the continuation of an uptrend. So ascending triangles can be drawn onto charts by placing a horizontal line along the swing highs, which is the resistance, and then drawing an ascending trend line along the swing lows, which is the support. Ascending triangles often have 2 or more identical peak highs, which allow for the horizontal line to be drawn. The trend line signifies the overall uptrend of the pattern, while the horizontal line indicates the historic level of resistance for that particular asset. So, 8th is the descending triangle. In contrast, a descending triangle signifies a bearish continuation of a downtrend. Typically, a trader will enter a short position during a descending triangle, possibly, of course, with CFDs, in an attempt to profit from a falling market. Descending triangles generally shift lower and break through the support because they are indicative of a market dominated by sellers, meaning that successively lower peaks are likely to prevalent and unlikely to reverse. So descending triangles can be identified from a horizontal line of support and a downward stopping line of resistance. Eventually, the trend will break through the support and the downtrend will continue. Next are wedges. Wedges form an asset's price movement tightened between 2 sloping lines. There are 2 types of wedge, rising and falling. A rising wedge is represented by a trend line caught between 2 upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance line. This pattern generally signals that an asset's price will eventually decline more permanently, which is demonstrated when it breaks through the support level. A falling wedge occurs between 2 downwardly sloping levels. In this case, the line of resistance is steeper than the support. A falling wedge is usually indicative that an asset's price will rise and break through the level of resistance, as shown in this example. Both rising and falling wedges are reversal patterns, with rising wedges representing a bearish market and falling wedges being more typical of a bullish market. So the last one are symmetrical triangle. The symmetrical triangle pattern can be either bullish or bearish, depending on the market. In either case, it is normally a continuation pattern, which means the market will usually continue in the same direction as the overall trend once the pattern has been formed. Symmetrical triangles form when the price converges with a series of lower peaks and higher lows. In this example, the overall trend is bearish, but the symmetrical triangle shows us that there has been a brief period of upward reversal. However, if there is no clear trend before the triangle pattern forms, the market could break out in either directions. This makes symmetrical triangle a bilateral pattern, meaning they are best used in volatile markets where there is no clear indication of which way an asset's price might move. So, well, summing up, all of the patterns which I talked about are useful technical indicators which can help you to understand how and why an asset's price moves in a certain way, and which way it might move in the future. So this is because chart patterns are capable of highlighting areas of support and resistance, which can help a trader decide whether they should open a long or short position, or whether they should close their currently open position because a reversal might happen very shortly. So, okay, this is all for this video. Thank you for watching, and if you like the video, then just subscribe for more.